On Business Incorporated today, Kenya gets World Bank loan of over 100 billion Kenyan shillings. And Côte d'Ivoire has its exports fall. And then we'll look at the impact of the U.S. debt ceiling deal on African economies, especially when it comes to debt servicing. Good afternoon. Welcome to the final episode of Business Incorporated on Channels Television. For this week, I'm Ini John Mekwa. We get to the markets now and see that major equities in Africa were positive, but we do have that NGX dropping. From yesterday's marginal gain, we see it at intraday down 0.15%, still holding on to that 55,000 though. And South Africa is doing good, just like yesterday, 1.94%, 77,254.44. We move to other parts of Africa, looking at Egypt now, which is closed for the week. Egypt closes on Thursday, but they closed positive, 0.21% at 17,533.31. Kenya also sustaining the bull run that it started some days ago. This week, mostly it's been positive, getting back to that 100 index point and sustaining that at 1.86% for Thursday. We move to the Middle East now, and we see that our major markets there are closed. Two of the markets are closed, but you have the UAE still trading today, Friday. Abu Dhabi is positive, closed positive for Thursday, 0.24%. Dubai also closed positive. And then we have Saudi Arabia positive also, as well as Qatar. Well, let's move on to Europe now. So what's going on there? And inflation is a major word going on there. Inflation in the Eurozone has significantly decreased in May, but the cost of living is still high. So it seems the numbers are not really capturing the reality. But let's have Andre Napori now join us from Berlin with the details. Hi, Andre. Good afternoon. So give us a broader picture at inflation in the Eurozone at this time.
Thanks for having me. Inflation in the countries using the euro as a currency, or the Eurozone, dropped more than expected to 6.1% in May. That's almost 1 percentage point down from April. The main reason is the lower price of energy, which finally started reflecting Europe's lower dependency on the supply of fossil fuels from Russia. Core inflation, which doesn't take into account the more volatile items like energy and food, has also gone down. That's the key indicator that the European Central Bank follows to steer its monetary policy. And data clearly show that the tight approach of interest rate hikes we've seen in the last year has started working. At the same time, we also started to see the side effect of the treatment, with some major countries seeing their economies slowing, and in some cases, like Germany, falling into a technical recession after 2 quarters of negative growth. That's part of the cure, for sure, but that also shows that despite good inflation numbers, we're not out of the moat just yet.
Yeah, you can say that again, because we see that prices are still at an all-time high in Europe. Management as some of the conditions for issuance of the loan. In March, National Treasury Cabinet Secretary had revealed that President William Ruto's government borrowed 8 new loans, according to 43.4 billion, amounting to 43.4 billion shillings. Let's take a break now. When we come back, we'll talk about especially the impact of that U.S. debt ceiling deal on African economies. That'll be on the other side of Business Incorporated. To stay with us. Welcome back to watching Business Incorporated here on Channels Television, and it's celebration sort of in the United States with that deal that has been reached about the U.S. debt ceiling or limit. Now it's been extended, and so the U.S. has gone past that risk of default. But what does it mean for African countries, especially those, almost all of the African countries, emerging economies, do service their debts? And we just told you about Kenya getting new loans from the World Bank, and all of this is serviced in dollars. What does it mean for them? Well, let's talk to Matt Kinnigan now, joining us to discuss this. Hi, Matt. Good afternoon.
Hi, good afternoon. Thanks for having me on the program today.
Good to have you. So while the celebration over there in the United States, because the default has been averted, what are the immediate implications for Africa?
Oh, well, I would say generally very positive in the short term. And this is because the way of looking at this is thinking about what would have happened if there were to be a default in the US, or if the debt ceiling agreement hadn't been reached. So it would have been very bad for Africa, really. And this is because we would have had a very sharp decline in stock markets. We would have seen significant capital outflows from emerging markets, including in Africa, and this would have exerted extremely severe downward pressure on currencies in the region. We've already seen a lot of depreciation of some major currencies, but it would have actually aggravated this trend. We would have also seen rising interest rates quite quickly around the world, a very sharp recession globally, and again, this would have increased debt servicing requirements or debt servicing costs for economies in Africa. So certainly it would have been really quite bad for sub-Saharan Africa. What we are expecting to see is an improvement in sentiment towards emerging markets, including emerging market currencies, a little bit less pressure on them, a little bit less strength in the dollar as sentiment towards the rest of the world improves. So certainly from a financial markets perspective, it is a positive development for sure in Africa.
So I noticed you said in the short term, is that also the condition for a long-term perspective?
Well, I mean, certainly, again, it is also quite positive for investor sentiment towards Africa over the long term. What we would expect to see is a bit more certainty for investors and businesses operating in Africa, investing in Africa. And this is because they don't have to worry about extreme currency volatility and extreme disruption to their borrowing plans or their investment plans. So less dramatic increases in interest rates, for example, less dramatic increases in debt servicing. So we could say that there's a bit more visibility and clarity over what will happen over the next 6 to 12 months. Having said all of that, it's worth remembering that we are still expecting the US Fed to maintain relatively high interest rates. We're not expecting a cut until the beginning of next year in the US's interest rates. And so this does mean that currencies in sub-Saharan Africa will remain under more pressure for the foreseeable future. We are also seeing public finances in Africa remain under pressure, as you just mentioned, the deal in the World Bank deal in Kenya. So positive over the longer term, but still there are a number of challenges that African economies must deal with.
Yeah, so, but does this disturb the commercial relationship with Africa, between the United States and Africa?
Yes, so, well, I guess there's a question we can ask here as well. It's about whether or not the status of the US dollar as a global reserve currency, including its use in Africa, is going to be challenged. What I would say is that the avoidance of a default, or this debt ceiling agreement, means that the prospects of African countries moving away from the dollar as a global reserve currency is incredibly limited. We think those views are overblown anyway, but it does mean that Africa's commercial relationship with the US is probably going to get a bit stronger. We do expect it to provide Mr. Biden with an opportunity to renew his drive to improve ties between the US and Africa, and this will take the form of his support for the African Continental Free Trade Agreement. We also would expect him to double down now on trying to sideline Russia's influence across the continent. So Russia is trying to expand its presence militarily and economically in Africa. So we would expect, now that a debt ceiling agreement has been reached in the US, Mr. Biden will kind of double down, will have the capacity to double down on building relations and raising the US's profile in Africa. So certainly we would expect there to be more investment and greater trading ties. So certainly quite a positive from that perspective.
All right, positive indeed. Thank you so much, Matt. But I guess it's about time that Africans also start looking inwards, and not wait for help from, the West. Thank you so much and have a great weekend.
Thank you, you too.
All right, so let's go to Morocco now, where that country has signed a memorandum of understanding with the Chinese electromotive group that wants to invest $6.4 billion in a battery-making complex. The name of the company is Goshen High Tech, based in Haifa, and specializes in energy storage products. It presently has operations in China, Singapore, Germany, and California. Last year achieved more than 100% revenue growth to reach $3.2 billion. It now intends to enter Africa with a factory in Rabat with an annual production capacity of 100 megawatts in creating jobs. About 25,000 jobs is what is expected to create in Morocco. And moving on to other countries now, we see that in Zimbabwe, the Zimbabwean dollar continues to weaken against the US dollar. And some Zimbabwean lawmakers have asked for official dollarization and halting the use of the Zimbabwean currency. Last time this happened was in 2009, when the local currency was dropped and replaced mainly by the US dollar after an episode of hyperinflation rendered it worthless. Independent MP Themba says no other way through this. In 2019, Zimbabwe, without its own currency for a decade, took steps to address its worsening economic crisis by allowing its surrogate currency, bond notes, and electronic funds to float, freeing against other major currencies, abandoning its official but artificial parity with the dollar. And Botswana has been ranked as the most financially literate country in Africa, with 52% of its population covered, while Somalia, with 15%, ranks least in the region. According to the Global System for Mobile Communications Association, in a presentation made here in Lagos with the theme Elevating National Policy on Financial Inclusion, Consumer Protection and Cybersecurity, Nigeria, Kenya, and South Africa are 26, 38, and 42% respectively. GSMA defined financial literacy as the ability to make sound financial decisions, acquire the necessary knowledge, skills, confidence, and competence to use financial products and services, and act in one's best financial interest based on individual economic and social circumstances. That's the program this Friday and for the week. Thank you so much for being a part of it. I'm Edie John Mekwa. Have a great weekend.